All right, good morning, good afternoon, good evening, wherever you are joining us from. Steve Thomas here with the Thomas Group and Real Broker, your local Las Vegas and Henderson realtors. I am here today with Brenton Van, one of our partners over at 5 Star Mortgage in Henderson, to have an interesting conversation about mortgage interest rates and some things that you can focus on to try and give you an idea of where mortgage rates may be heading in the future, because I think that there is a lot of misnomers out there in the world that is regarding the Fed's fund rate and interest rates, and we hear it, and I've seen it personally in the news myself, is the Feds, increased their benchmark by another 0.5 point. It's killing home ownership and blah, blah, blah. But that's actually not really true. And a lot of this is kind of like scaremongering and creating headlines to get people to like clickbaity kind of headlines. And I want to try and just break down some of the misnomers and get to really some of the truths behind what is affecting mortgage interest rates. So Brenton, very good day to you. Good morning, sir. Thrilled to have you.
Oh, I appreciate it.
So we've been talking a little bit about this in detail, but why does the Fed's benchmark not necessarily affect mortgage interest rates?
Yeah, so like you said, it's a little fear mongering, and they don't really separate the two as they should. So the Fed rate specifically is just the rate at which the Fed borrows money, right? So the reason that they're raising it is because they want to reduce inflation. So if we're borrowing money at a higher interest rate, then that's going to reduce inflation. And that's the only goal that the Fed's trying to accomplish. Now, how fast they do it, how long it takes for them to get to their 2% goal is something, that we'll see. But with the Fed raising the rate, at least the last 3 times the Fed's raised the rate by like 75 bips, and then they're going to do 50 again. The reason being is because that brings inflation down. So as soon as inflation goes down, that directly correlates to your mortgage. The Fed rate at which they're borrowing money really doesn't have much to do with interest rates. It more so if the Fed raises the rate and the inflation comes down, your mortgage rate's going to come down. And that's the difference between the two. They don't really differentiate that on the news or anything like that, but we care about inflation. That's all we care about from the mortgage perspective.
Sure. So I've been recently learning as well that a guide that follows the mortgage interest rates very, very, very closely is the yield on the 10-year Treasury note.
Yeah.
So why does that so closely correlate to mortgage interest rates?
So the 10-year Treasury note, basically that's like the par reading at what interest rates are going to be. They don't always go off of a 30-year. They go off a 10-year Treasury note because that's what's going to drive the market up and down. So if you follow closely, if the 10 years going up, interest rates are getting worse. That's an easy way just to tell. Now they're never going to jump, 0.5% or anything like that. They're very small moves. For example, we were at like 3.8, and then we went up to 4.2, then 4.5, and now we're all the way down. I believe today we're at a 3.59 today. So that every 1/8 of a point, maybe 3.55, every 1/4 of a point down is going to be not a very drastic move, but you could actually tell where we're going. So it kind of trickles down, and it's not always a straight shot. We'll lose, then we'll gain, then we'll lose until we get some of these bigger markets and we get some of these bigger announcements. Then sometimes they move pretty substantially.
Sure. So the 3.2, the 3.5, 3.84 that Brenton is talking about is actually the yield, right, on the 10-year note. And I think this is probably a good point, Brenton, for if you could share, your screen and just show everybody this, some of these charts that you've been showing me. There's some really interesting data that we can actually look at here and try and analyze to forecast, where we're going in the future?
Yeah, definitely. So I'll show you this right now. So right here is the 30-year. So when I refer to bips, those are called basis points. And just for reference, basically 100 basis points is about 0.5% on your interest rate. So you can always cut those down and know where the 30-year is. So if we're down 44 basis points today, instead of let's just call it a 6, your rate would probably be a 6.25, right? It's about half of that. So the 10-year treasury right here is what we're talking about. That's up 11. We'd like this number to be red and this number to be green. It's just not the best day today, which Mondays typically aren't. So no biggie there. So where we're floating, so right here, you see, this is where it got crazy. And this was in September, right? We lost all of this in September, and then it got okay, right? And then we lost all this again. So we're slowly trickling down like we discussed, and it's not always just a straight downhill. Sometimes there's some turbulence along the way. But now here's the important part that we're at. So these are basically like levels of inflation and like ceilings and or protection. So this is a ceiling right here at 3.64. So that would be the 10-year treasury yield is at 3.64. Now, the 100-day moving average is 351. So that's basically the moving average of the treasury yield and the average rate that we've seen. So that's 3.51 here. So we have, this is a floor of resistance is what they call it. So if we can get under 351, which we're at 359 now, then you see that this little gap that we have right here from 351 to 3.42 is how much that we can, how much better rates can get. Now, this is the Fibonacci level that we discussed, right? So if you look at this and you get under 342, that's going to be a huge day for mortgage rates. And the reason being is because if you look at the next, 100-day moving average right here, this blue line, there's not any help, any resistance from 3.42 to 3.20, which is a huge decrease. As you see, we lost 11 today, right? So basically it opened at 3.50, we're at 3.59.
Okay.
Now that's 44 bips as far as a 30-year mortgage is concerned. So you can imagine if we get down from a 3.42 to a 3.2, that's probably going to be right around like 100 basis points and or 0.5% in interest rates, which they are projecting to come the beginning of this year coming up.
So just to, in layman's terms, that's going to equate to what mortgage rates in the 5% range?
Yeah. We'd be, so we're low 6s right now. If we get below that 342 level, as far as the 10 years concerned, we're going to have a lot of room maybe to get to about 5.5.
Interesting. So I don't know, I don't know a lot about trading, but I know enough to be dangerous. And I'm just looking at this chart that you have up here, and this the R1 line, the 3.644. That seems to be a very interesting line for acting as support. And then when it actually broke below that line, it's now been testing that. That's been resistance. And I mean, I know you're not a trader, but how many times should we anticipate it increasing, testing that resistance level before it then breaks below?
So it's going to test it and it's going to keep testing it. But the biggest thing are these reports that come out this week. So with the reports, the reports are usually about a month lag behind. So when these reports come out and it gives us their favorite inflation readings, if inflation goes down 0.25%, even 20 bips, 30 bips, that's what's going to make it go down to that 342 level and test it. Because as we know, inflation goes down, that's where rates want to go. So it more so just stays there and floats in that line. It keeps testing the market until we get some news with the inflation going down. And as soon as we do, that's when a lot of bonds and things like that will sell off. And then that's what will test the market and give us under that 342 number.
Okay, interesting. So for everyone out there, what are these reports that are coming out that everyone should be keeping an eye on?
Yeah, so there's something called the Consumer Price Index, and that came out last week. And that basically is a measure of inflation by the Fed. So the last two CPI reports that came out, we went from 6.6% to 6.3, and then we went from 6.3 to 6.0 last week. So we've dropped, 0.6% over the last 2 months, which is good. We were only supposed to drop in between 330 to 40 bips. So what comes out about a week after that is called the PCE, and that's a personal consumption expenditure. It's basically the amount of money that everybody's spending and inflation rates with that. Now that usually follows the CPI, which is a good thing since the CPI came in a lot lower and inflation dropped. When the PCE comes out, and that's Friday, if we see a cooler result and or it doesn't come in as high as we think, which we are projecting that it's going to come in a little lower, that's when we're really going to test that 342 number and we can see a breakthrough in rates. It's not going to be anything drastic, like 6.25 to 5.5 right away, but seeing those positive markers of inflation dropping is what's going to test those markets and see where we can go with rates.
All right, very interesting. So, I mean, it looks like we have. How do you think? Do you think we're through the worst of it, like in terms of the high interest rates on home loans now? Then is that?
I do. I mean, in September we lost like 400 basis points in a month. So as you see that, and you see these numbers here, I mean, we're here and we've been pretty steady there for like the last 2-3 weeks. Now we just need to get some of these reports coming in, inflation to cool off a little bit. And as long as that happens, I think we're going to be on a downward trend into next year. Okay. It might fluctuate on a weekly basis, get a little better, get a little worse. But that's also why you want to work with a real estate team and a mortgage broker who kind of understands these things a little bit so that we know when you get into contract, we do have 2-3 weeks to lock in your rate. So, I like to give people options. Hey, this report comes out on Friday. It is a little bit of a gamble, but if it were my house, I would wait until the report comes out because we're going to get a better inflation reading, which might reduce your rate.
That's great advice. That's excellent advice, and I think that's a perfect point for us to end on, Brenton.
Oh, awesome!
Appreciate you explaining all of that to us. Some really good key takeaways there, I think, for everybody to pay attention to in not just reading and believing what you see in the news. Look at this data for yourself because this is going to be able to give you a more transparent picture of how everything is looking. And of course, if you need a great mortgage broker, loan lender in town, Brenton and his team do an absolutely phenomenal job. It's easy for me to say. And,
I appreciate it.
And we're not bad either. So if you need any
great
help,
over there. It's hard to find an agent that actually understands these things as well, so giving your buyers some peace of mind knowing that things are going to get better. I think it's still obviously a great time to buy with where we're going. I think the market's going to be hot next year, but you guys are the professionals with that.
Oh, thank you. No, I think it's been a very strange time, right, for everybody, and I think people can get caught up in the hype of things, and I'm not one of those YouTubers that sells the fear. I want to try and bring truth and transparency and just honesty to the content that we're creating and the way we do our business, and I think that this has hopefully been a great video for everyone out there, and they haven't been lost in all of the crazy terminology, but they've managed to follow along. And we'll put all of Brenton's information on the screen. If you need a great loan officer, make sure you hit him and his team up. But for me, thank you so much for watching. Brenton, appreciate you joining me, and I'll look forward to seeing you again.
All right, anytime. Thanks, Steve.
Thanks, everyone. Take care.
All right.